Hello, fellow investors. Welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Most investors hear the word litigation. They immediately think lawsuits, headaches, wasted money. But what if it was actually a source of alpha? There's a way to unlock hidden value and take control of deals that others walked away from. Today, we're diving into how smart investors are using the courts, not as a last resort, but as a strategic weapon. My guest is Chris Zona. He's a partner at Mindlebaum Barrett PC. He's a veteran litigator. He's tried more than 50 cases, including 30 jury trials. He's also advised one of the largest healthcare companies in the world and now helps real estate funds use litigation to create alpha in distressed and value-add deals. So Chris, welcome to the show. How you doing?
I'm doing well. Thanks so much, Ken. I really appreciate you having me on. And, as you read, it's a little bit of a novel concept. I'm sure I'm a little bit of a novel guest for an investing show, because the number one thing I'm sure everybody thinks about when you hear litigation or an attorney is money coming out of your pocket. And hopefully after we speak, there will be a little more solace when people pick up the phone and call their lawyer, because maybe we could bring some dollars in rather than them always going out.
Yeah, and I think that's a perfect segue for where I wanted to start, which is, what is the biggest misconception that investors have about litigation?
Sure. And it's historical. Litigation and lawyers are cost centers, especially if you're not a deal maker. So, most of your investors are probably using lawyers to finalize documents, read through agreements, make sure they're kosher on that end. And they view that as a necessary expense. They may grit their teeth, but it's helping them make money, right? You're finalizing the deal, making sure all your I's are dotted, your T's are crossed. The misconception is that litigation has to only occur and kind of be endured when either you've been harmed and you're trying to get your money back, or when someone alleges that you've harmed them or done something wrong and you're trying to protect yourself. Both of those scenarios are negative, right? There are negative connotations that go to both, because they're not going to make you money. They may protect your money or they may get your money back, but it means that dollars are flowing out from your bottom line and you're spending money. Where I think that the misconception is that is the only place that someone like me can actually assist. And what I've tried to delve into, and I try to help investor clients and kind of businesses as well, because the concept is fairly multifaceted, but specifically here, investors understand is, hey, you may call me in that scenario, but don't lose my number. Because if you call me again, I may actually be able to help you unlock value, unlock alpha that you otherwise maybe couldn't, or maybe just didn't understand that it existed there.
I got it. So look, we all probably think in the same way, right? It's litigation is about playing defense. You're always kind of on the back foot, right? But what your thought is, there's some offense there that can be played. So let's unpack that, how that shift works a little bit. One thing that you said was that litigation can be both a scalpel and a sword, right? That's a pretty powerful image. You think about it as a shield, right? You're just trying to protect yourself, but you could actually go on offense with this. So what does that mean in the context of real estate investing?
Sure. So, let's kind of take out the idea of kind of affirmatively litigating a claim of someone doing something against you, right? So let's specifically think about it being like an affirmative, happy experience in which you're going to try to generate a return, generate something for either yourself or your investors or your fund. So in that sense, when you're talking about litigation as either a sword or a scalpel, you can use litigation to help you actually process deals with whatever your back end exit is going to be. So let's take, for example, you want to gain properties into your multifamily portfolio or your commercial portfolio, and you're looking to access additional properties, right? Well, the common way to do it is you're cold calling, you're dealing with agents, you're dealing with middlemen. Well, another, and this is kind of more of a bolt-on. I encourage people to understand this as a bolt-on rather than a standalone concept, because very few people can do this as a standalone concept. But the secondary note market. Specifically here would be your secondary loan or mortgage, securitized mortgage market is very active. Banks are commonly de-risking very early on, right after they deploy capital. And that's because they don't want to keep it on their books. So they're de-risking both performing notes and non-performing notes. Well, that is the access point that investors can have, whether it's directly from the bank or from a secondary lender who then buys and then wants to resell. When a note starts to look like it's going to become non-performing, so that means that the borrower is experiencing difficulties or has defaulted on one of the many covenants within the huge packages of loans that we see. Normally, it's a payment covenant, right? That's the easiest one for us to conceptualize. So let's stick there. So they've missed a payment, maybe two payments, and per the agreement, that now becomes a non-performing loan. There's a default on it. Now, the bank doesn't want, or the bank or that immediate lender usually is not in the market to own and operate property. Their first instinct is never, I'm going to go in, take this property over, because guess what? It costs money, which hurts their bottom line because it's not their business. If they're successful, it doesn't help their bottom line because now they've gained an asset they have to offload. So there's really no upside. So a lot of times what will happen, and normally what's happening, and you're seeing this more and more now, is that non-performing note is being marketed to the public or to, potential investors to purchase. And they're purchasing usually below par. Now, as depending on where the note is, how much below par we're talking is going to be kind of different. But if you're outside of your major markets, that note, depending on how non-performing is, can be purchased at, a significant discount. Now, where is that advantage? Well, the purchase, one, as an attorney, I have a lot of banking, finance clients, but I also have partners who work in the banking and finance realm. They have a lot of lenders who are in these markets. So yes, deal making, deal flow is something that lawyers can assist you in. But specifically with more what I personally am doing is once you're into that note, so you purchase the note at, say, a discount. You talk to whoever the lender is, they want to offload it, and you come to an agreement and you buy up that note. Well, now you own the actual, a non-performing note, and you have now access to all the covenants therein. So if you want to utilize someone like me, what's the first thing we're going to do? We're going to scrub it for every single covenant that we think may be in breach. That's not to say that we need to move on all of it, but we're going to look at it and say, okay, if at the end of the day we need to move on these so that we want to actually take this property over, a hostile takeover by one means or another, whether it's a pure foreclosure in court, if you're in a non-judiciary state, it's non-judicial foreclosure, whether it's, if it's owned by an LLC or securitized against assets, if it's some sort of UCC action, or it's a, deed in lieu of transfer or a title transfer or some sort of negotiated workout. Let's start by sending notices and let's walk through the process together on the road to taking this property over for your investment, for your portfolio, when it was never on the market. Not only was it never on the market, but commonly if you're, with the right diligence, it's probably a property that even if it was on the market, you, the investor, couldn't get into, whether it's because of the access to the market, because of the cap rate, or just the actual purchase value. You're just not going to be able to purchase it. So that's kind of the concept. And, when we talk about a sword or a scalpel, as a sword, we're going all the way to foreclosure, right? Like that is swinging the sword, the big stick. You're coming in, you're in for the long haul. It's going to be serious litigation if you're in a judicial state. More scalpel-like is to look at certain covenants in there that maybe aren't as obvious as a payment covenant, where you can gain leverage and hopefully negotiate some sort of workout with the borrower. Perhaps that's a leverage to a workout where you grow a longer tail on the note. You add some covenants in, and now you become just the note holder and baby, like a baby bank, and you just let the note perform.
Yeah, that's all really interesting. So one, it can be an additional source for investment opportunities, right? You talked about Yeah, you don't think about attorneys in that way, but attorneys and then going through banks and relationships can become an additional source for investment opportunities. But then as you're talking about getting into those opportunities, it's not about, doesn't sound like it's as much about like suing people as much as it's like creative leverage or the ability to get control that you wouldn't be able to through, you know, like you said, a property through a traditional format, like through, going on, maybe it's not on the market or things. So it sounds like there's a couple ways where you could either get control of a property or you could just create, how do I want to say this? A more, I guess, sophisticated kind of workout strategy that works for you you've bought the note at a discount and now you can create a way to actually get paid back on it and create a good ROI for yourself.
Yeah, 100%. I mean, what I think people have to realize is, when we think about litigation in the world of like a foreclosure, that's the end state. And it's usually the state that I don't want my investor clients to be in because it's the longest, it's the longest, most expensive run. You're going to run through a lot of your returns that you're going to otherwise be able to return to yourself or your investors. Yes, it's great when it happens, but usually there's just a long life cycle to it. What's important, I think, to understand is that there is a lot of flexibility in the approach, but also the exit strategy, right? We can tailor this approach to, I'm a quick turnaround. I want to force a foreclosure, but I want there to be an auction sale because I got in at a very good price. Okay, we can do that, right? If we're in the right jurisdiction, we can force the issues so long as we have the covenants to do it. And obviously that's part of the diligence process, but we can force that strategy, which is you being almost a flip. You're in and then you're out. Conversely, my exit strategy is long tail. I want to build capital. You're an owner operator. I have the operations. I have my management company. I just want to accumulate more and more units and more buildings to then manage. And whatever the tail is, the tail is. But I don't foresee that I'm going to be getting out of this property because for whatever reason, this property is where I want to be and what I want to be in. Okay, well, let's utilize the leverage. Obviously, I'm still, I'm one of those people. I'm a trial attorney. So I'm thinking about end state. I'm always thinking about how are things going to work out if everything goes to hell and we need to litigate. But along the way, I want to off ramp. And if the off ramp is a workout strategy in which, we're renegotiating the note to make it better for the borrower, say the borrower is, they import, Chinese furniture right now. So they're having a ton of cash flow issues, but foreseeable future, they're probably going to be able to make it. But for the next couple years, they're not. Well, they may be in default. But if your interest in that loan and you've purchased that loan with that concept and you understand that there's a cash flow issue, well, let's do a negotiated workout where we, remake this note to make it more beneficial to the borrower maybe in the initial term, but we add tail to it. We defer some interest. We push the rate up. So in a lower interest rate environment, we're doing very, very well. And we add some additional covenants in. Okay, well, we're getting to that point through the leverage of litigation and through utilizing the tactics. So those are kind of the two opposite ends of the spectrum, but anywhere in the middle, if you're looking at a medium exit strategy, depending on what your returns look like, if you have investors to answer to, you can very much adjust this up or down to the size of the property, the type of the property, but also to the tail on your investment.
Yeah, I think that's really interesting. And it's definitely not a strategy I'm familiar with, but I could see how you could create a lot of value there, right? And you could create a win-win. Like you could like this, it could sound like you're coming in and kind of taking over for somebody else, but in the example you just described, I mean, you're creating really a win-win scenario there, where you're helping somebody out of a situation where if they were just to be dealing with the bank, they're going to default and they're probably going to end up losing their business or their property, right? But if you can come in and understand the situation, kind of work it out to a point where they can keep going, right? And so, I mean, I think that's pretty cool that you actually can create these win-wins for people.
Yeah, no, right side. I think the most important thing to understand is that it's a strategy that can be right sized to whatever you're doing,
Yeah.
and it could be also adjusted to whatever market you're operating in or an up market that you want to enter or not. I think commonly when I know for me, I'm in the New York City metropolitan area, and most of my work's in New York City. Usually when I'm talking about this, there are a couple big players in the game and they're funds. So they have, 9 figures behind their deployment strategy. Well, and they strictly do this sort of strategy. Well, that's really not the demographic that I'm working with, nor is it the
Mhm.
demographic that I think this is most beneficial for. Because when you're in that larger realm, obviously I would love to have those funds as my clients, but they're answerable to those returns. So when things start to go sideways, they don't have the option to remake their exit strategy because they need to offload. They don't want to own and operate. That's not the fund strategy, and that's not what their investors are putting their capital in for. When you're kind of coming down from that to a more manageable, investor or investor group or a smaller fund who can be more flexible, you can really opt fluidly what you want to do. Say you really thought you wanted to take over and sell out, and then the market conditions change and we're on the pathway to do so and we're clean, but all of a sudden it changes. Well, now we could perhaps, use where we are, leverage our positioning to then remake the deal to something that's more beneficial to whatever your exit is. And we're able to do that because we're it's a more fluid mix and a little more, optionality on the back end.
Yeah, I mean, it seems like there's just unlimited creativity to how you can restructure and do things and figure that out. And that's part of where your guidance comes in, right? Because you've seen, probably almost every scenario and how things work and don't. And so I think that's right on. That's really interesting. For somebody that for somebody that is not, the big behemoth, as you said, and, kind of an individual investor or a group of investors, what's step one to get started kind of in this type of strategy?
Sure. So step one, I think, is to understand where it might fit with whatever your overarching strategy is. So I think for the individual that you just described or the group that you just described, more than likely that group is looking for long-term capital appreciation within probably a single or a handful of markets that are outside of your major metropolitan areas. So you're talking about secondary and tertiary markets across the country. They're probably already in those markets, so they have a concept of value and diligencing value and understanding what returns look like. So if we take, obviously, I don't want to get too technical, but if we take those as the assumptions, your first step is to really understand what your deal flow contacts look like. So, usually in that scenario, you're dealing with one or, less than 5 lenders, probably regional banks, regional credit unions, because most people aren't just raising straight capital. They're leveraging their capital for financing. So you probably already have a handful of relationships to lenders that, whether it's and I'm talking about everything from bank and non-bank lenders. If we're talking about hard money lenders, if we're talking about, bridge loan lenders, anyone who's in that space is going to have some sort of exposure and connection to the secondary loan purchase market.
Right.
So that really is step one, is to talk to those individuals and to leverage your relationship with them to understand, hey, is there opportunity in this market? What are you seeing? How far below par are things going? You know my portfolio because more than likely you've leveraged your portfolio for additional loans to make your next deal. Is there anything that may be in that mix? That's really step one. Obviously, lawyers can help in deal flow. I always say that we can always help in deal flow, but I also don't want individuals to think that I'm like the deal maker who's coming in with this bucket of deals. There are people who do that. I don't do that. I'm the litigator. My partners have some lenders, but usually I'm going to say to investors, you want to leverage your contacts because you have a longer relationship to them. And you're also probably in that market. There are investors, but a lot of investors are investing in their home market.
Okay.
Most people, especially if you're looking for long-term build, you're not going to be like across the country because it's really hard to visit properties that are across the country.
Yeah, that makes sense.
So That's really step one. And then step two, I think kind of the next step is to really understand where it fits. If you want, if say there is within your market, there's more than likely space for you to operate this. Where does it fit? How much do you want to grow? Do you want to go from 4 to 8? Do you want to go from 4 to 20? If you want to get up to 20, then I would encourage you to definitely be looking at something like this. But usually I say, if you just want to grow one by one and your strategy isn't this, then I wouldn't suggest you use this as your one by one growth strategy. If you want to grow multiple properties, say you've had really good success, but you and or your group want to double in size. Okay, well, think about like scouring for those really, really attractive deals becomes hard. And if you're a small group and you're not going to spend the overhead to offload finding them, you're talking about a significant amount of time. And that time may be better developed, either looking for what that next tranche is or raising a new fund or whatever it is, rather than always looking for that one perfect deal. So this becomes a bolt-on strategy that you can utilize and just investigate. And that really is what I tell everybody. This isn't a do or die type of thing. Like, you don't have to hire me. You can retain me to strategically advise you. And if you get something or I bring you something and you like it, okay, then you're spending money. But until then, it's not as if you're, I'm on every deal you're on trying to litigate it. No, I don't want to do that. I don't want to mess with your business. I want to grow your business kind of that with whatever makes sense for that next stage. So I think those are the two kind of initial steps. I would want to know what my secondary loan market is and whether or not I have contacts or I need to make contacts. And two, I would want to know how it's going to fit with your portfolio, such that it's not really disrupting what you're doing. Because I don't think that's helpful to investors. I don't think this type of strategy should be like I'm dropping everything I'm doing and only doing this.
Yeah, understood. Well, I think those are some great first and even second steps, right? And it sounds like it's a pretty reachable to start in that, if you're out investing, you probably, like you said, have some bank contact or some other lender contacts, and you really start there and getting a sense of, what does the market look like for this and where opportunities might exist, right? And letting them know that you could be a source to help them offload, some of their loans that they may not want, right?
No, absolutely. And it's going to be a two-way street, right? Because they're going to want to leverage their relationship with you so that you continue to finance with them on deals that maybe aren't of this nature, but you're also helping them, right? I mean, any type of lender who isn't in kind of the super high interest rate type of loans, wants to get rid of things that are risky. Because they could redeploy capital. Even if they take a loss, they could redeploy capital, and the interest rate they're going to make on the redeployment is going to make up for any loss, rather than crossing their fingers and hoping something becomes performing. And I think you offer sometimes an out. And if you're not in the major markets or even kind of those big secondary markets, then you're probably not going to be coming up against your huge bucket investors. And by that, I mean these large private equity firms who are buying hundreds of millions of dollars of loans and helping, large national banks de-risk, huge amounts of their portfolio, or even the government, right? Fannie Mae is commonly selling loans and getting rid of stuff, whether it's performing or not. And depending on the structure of those funds, they may be buying performing loans, they may be buying NPLs, but you may be able to, being in kind of a lesser market, and I don't mean that pejoratively, but you can kind of excise those major players from your competition. And you could also understand it, like you said, from the relationship. Hey, are you mostly dealing with, bucket buyers? What's the bucket? What do the buckets look like? Are they, $2 or $3 million like four, or are they 30 or 40 million? And, it may or may not be the right mix for what you're looking for.
Yeah, no, fair. Understood. I think great explanation. And so I'm thinking now, switching to focus on more of like value add type of projects, right? Where there could be ways that litigation could create value as well. Say like, clearing title or removing a non-performing partner, or, maybe some different examples. I'm thinking about now, if we're going after projects and opportunities, maybe some examples of how litigation could kind of expedite things or create value through deals, that we may overlook, or we may say, oh, it's too hairy otherwise, right? With knowing what we know now.
Sure. So, I mean, most of my existing contacts and clients in this space have come through using me in other senses, right?
Good.
Where they've come to me for, litigation, whether it's a risk assessment or actual litigation. And then we've started to have this conversation and then we've transitioned. And I think the reverse is true as well, right? If we're talking about X, Y, or Z in this sense, and kind of the going out and using affirmative litigation as a strategy for investing, the value add becomes, I already know your portfolio, right? Like I already know what you're dealing with. So if you have existing properties that you want to take certain actions on or you're experiencing problems on, you already have me. Now, if you're talking about straight, when you say value add, like quiet title, things like that, there are easements issues, there are tax issues. Yes, those are ways. I think those as investment strategies, they become a lot more specific and determinative, and they're also harder on the back end to conceptualize how you get a return out of them, right? Because you have to really understand, like, okay, if there's an easement on the property, how do I navigate that within the return of the property such that I can kind of adjust that return for whatever the expense to actually litigate the easement. And I'm not a big fan of government involvement. Once the government gets involved with like taxes and things like that, like litigating against the government is never useful. Unless it's really going to save you money. But if you're looking at kind of an affirmative way to use litigation, kind of if you're looking at trying to litigate out taxes, it's a tough deal. I think it's tough on the returns. It's tough on the upfront diligence. I think the place where the value add comes in is the covenants that are probably not as commonly understood or commonly known that are going to be buried within your documents, especially if you're looking to purchase documents or you're talking to your lender about purchasing loans, because everybody knows payment, but maybe there's a net worth ratio. Maybe there's an interesting LTV ratio covenant that isn't normal. Utilizing me for other types of things like a receivership or lockboxing. Yeah, it's not very fun, but it's a great way to leverage if you're going up against, another owner operator who's the borrower. They may be doing their operations, so they're going to be less inclined to give up the operation because they're making, continued income on operations, even if they're behind on the note. And that income may be paying for everything. Pursuing a receivership or a lockbox once you own it is, a step short of actually litigating out on a takeover, but it will secure, payments on your note if you're in a longer tailed, investment cycle, right? If you're thinking, hey, I want to keep the property, I don't want to take it over, but I want to keep the property. Do you want to pursue some sort of lockbox where, you're getting paid for, you prioritize your payments over distributions, or you prioritize your payments over, say the management company being paid, things like that. I mean, they become a lot more nuanced because they're really determined by whatever the property has with it. I think when you said whether or not a property is hairy, investment deals that are hairy, I think are the kind of investment deals that this type of strategy generally is going to be dealing with, because they're properties that perhaps are underperforming, and whatever the reason for that underperformance is going to be your avenue in. So it really becomes a diligence process on whether or not the kind of the end state that you intend for it is going to meet with whatever you are willing to put out.
Yeah, understood. It's more again, I think using litigation as a tool to just allow you to, it sounds like, go after more deals, confidently evaluate deals, and understand, as you get in, if you're an investor, it's going after things with, like I said, a little more hair on them, right? Having the right team in place and making sure you can do that evaluation on the front end makes a ton of sense. And so I'm curious, as we look at the future, right? And where we're going, or even where we're at right now, what are there specific types of deals, or are there specific markets where maybe you're doing a lot of work in and you're seeing that are ripest for these type of strategies we've talked about?
Sure. So obviously, if you're looking at where things stand right now, I think I wrote an article for the New York Law Journal. And I think something like $1 trillion in matured debt is going to be coming up at the end of this year, the beginning of next year. I was just at IMN's Distress CRE East, and the situation is, there's a ton of debt that's maturing. The commercial market is struggling. Owners are in tough straits. So I think it is a market that I think nationwide, whereas a lot of times we see it as city by city. This city is having a tough time, and it's as a distressed assets, and people will kind of swarm there. Right now, I think nationwide, there's a lot of stress in this area. And I think the stress is turning into distress. And so I think that there are going to be more opportunities in more markets right now. So that's one. Two would be, obviously, in your major markets, there is a ton of competition. And I think getting out of those major markets is necessary to really, be able to leverage relationships with lenders. I think kind of stepping down even from those secondary markets to your small cities, your bigger towns, where probably most people who are passively investing live. Those are going to be the ripest because it's the hardest place for banks to offload. They're more likely to have your regional banks or smaller secondary lenders rather than national banks who can offload to big funds. And also, it's more likely that you're going to personally have a relationship with someone in the bank, and they're probably more eager to de-risk because their margins are lower, because their volumes are lower. So capital is going to have a larger premium with them. And then emerging markets are always emerging markets, emerging areas within a market, right? I think in New York City, right? If you were a distressed buyer, well, during COVID, but if you go back, if you were a distressed buyer in Midtown West in the 70s and the 80s, the 90s, and you started to take over some of those kind of decrepit properties and turn those around and resell them to developers. Right now you see gentrification moving, way up in Harlem, but in other cities, Nash, look at the explosions in Austin, Nashville, Charlotte, 10, 15, 20 years ago, those were all beautiful cities. They were doing very well, but they didn't have the national presence that they had. And where that creates an opportunity, I think, is that, well, as development and as commercial development and business development happens, especially within the multi-unit residential area, they have to find places to house people. And usually it's happening too fast for development to catch up, right? Think about how fast Austin has moved. In 5 years, it's become a business capital, and you have, major players moving there. Well, they need to house people, and you just can't build fast enough. You can't build towers fast enough, anywhere. So having that kind of smaller multi-unit, that under 20 units or under 50 units, those type of assets, kind of trying to foresee where that's going to be, tracking the market, tracking trends. I think those sort of emerging markets are really attractive for this type of strategy, especially if you want to be long-term, right? If you have a long tail. Obviously, if you want to flip it, it's a little different because maybe you don't care about the operations on it. And maybe you're thinking of it more like, I'll turn it over to a developer. They'll do whatever they want to it. They'll remake it, or they'll, just reincorporate it. But if you're thinking longer tail, yeah. If you were in Charlotte 25 years ago, you're doing pretty well right now. And, whether you want to operate it or sooner or later exit.
Yeah, absolutely. Well, it makes a ton of sense, right? It's some of these fast growing markets. And then I heard you say, it sounds like, and I was curious about this, even deal size, like just thinking about who the counterparts here, the local or regional banks. I'm assuming a lot of their deals tend to be smaller deals, which would be more approachable to more of an entry level investor or somebody who's, going after, like I said, a 20 unit or a 50 unit, right? Versus big group who's going after 200 units. So there might be opportunities on that lower end scale, for investors, to get involved without having to have so much capital, and be able to go after kind of these smaller deals in these emerging markets, you said. So I think that's a really good little nugget for folks to be able to take away as a way to kind of target where they start to look and build bank relationships.
No, absolutely. I mean, that's what I say. When I say you could right size this, you really could right size it to whatever you want it to be, because, a lot of my conversations happen and I use a lot of funds just because my background's been in the city and been working with funds and things like that. But as I am talking now with a lot more investors, either solos or groups or thinking about raising capital, the reason I like this strategy and the reason it's one of the strategies that I pitch is that it could be downsized to wherever you want it to be, because you're not going after a $40 million property. You're going after a $500,000 property. And the person who's still having trouble at $500,000, it's not like the trouble's different. If you're not paying your mortgage, it doesn't matter. People are foreclosed on and go bankrupt when they have a $200,000 mortgage or a $2 million mortgage. It really doesn't matter. What matters is that you're right sizing the approach to whatever your strategy is, and then you're trying to figure out whether or not that's attractive to banks. And like you said, smaller banks do smaller deals, but also when people are coming in and buying buckets, they're buying larger buckets with larger loans because they usually have a directive from their investors to deploy a certain amount of capital. And they don't want to have 250 loan notes that they're purchasing to hit that capital. They want to have kind of the prime territory of those 15 or 20 big notes. Well, you probably aren't, you as that solo investor or that new investor in this, that's not where you're going to make your money. Maybe you're going to make your money in that smaller note, that $750,000 or that bucket of, $300,000, $400,000, $500,000, 4, 6 units that you can operate, that you can do it leanly, or you can get the borrower to turn it around and get that performing, whatever it is. But now you're talking about a much smaller capital investment and something that's much easier for you to leverage your relationships to pitch. And for the bank, something that's probably a little bit harder for them to get rid of.
Awesome. Well, Chris, this has been a masterclass in all types of things, or legal, distressed investing, how to get started. So appreciate all the info. I want to take us now into our keys to success round. We got 4 questions I want to ask you. The first one is, if you were an investor and you were going to make an investment with someone else, right? You're going to invest in somebody else's deal or project, and you can only ask them one question. What would that one question be?
Well, as a lawyer, though I sound creative, I'm probably more concrete than most. It's historical returns. I think my number one question would be like 10, 5, 3-year historical returns. I know that history isn't a window to the future, but if I see historical returns, then usually it can at least give me a suggestion that, or some solace that, hey, this person, maybe the deal won't be great, but they know how to make sure the deal makes money.
Yeah, absolutely. What are you most proud of in your career?
Oh, probably serving in the military. After law school, I graduated and then I commissioned in the United States Air Force as an officer. I was a JAG officer, so I wasn't a flyer. But commissioning in the military, served 6 years. Left right before I put on major.
Thanks for your service. What book should everybody read?
I'm a thriller addict. So I read a lot of operative CIA type thrillers. I would say read Vince Flynn's Mitch Rapp series.
Okay. All right. I like it. And then last, what is your number one key to success?
Probably persistence. I find that if you're persistent, then you can sometimes move the universe in ways that people who are kind of one-offs can't. I try to tell younger attorneys the same thing, that if you just kind of keep keep kicking the tree. Sooner or later, it will fall. Even though, for the first couple of years, it may not seem like it will. It will. And I think it's served me well in my career.
I think that's fantastic advice. And it's a common theme that we hear on this show. And it's just, the people that succeed are the people that don't quit. That's absolutely right.
Yeah, keep chopping.
That's right. Keep chopping. I like it. So Chris, for our listeners who want to learn more, want to connect with you, what's the best place for them to find you online?
Sure. Probably my LinkedIn, and it's just Chris Zona, Zona. A lot of the content that we're talking about is on there. I have a 3-part series on there where I just talk about distress, but specifically real estate investing in this realm. A lot of my published works are on there. You could also find me at my firm's website. The firm is Mandelbaum Barrett PC. The website is mblawfirm.com. I'm on there as well, obviously my bio and everything, but you can also see we're a full service firm. So you can see some of the other offerings we have and how we couple together servicing for clients.
Perfect. We'll link all those in the show notes. Thanks again, Chris. It was a fascinating look at the intersection of law, strategy, real estate alpha. And for everybody listening, remember, sometimes the most valuable assets aren't on the balance sheet. They're in the courtroom. And with that, Chris, have a great rest of the day. Thanks for coming on.
Thanks. You as well. Take care.